Thank you for tuning in to the Black Money Tree Podcast, hosted by entrepreneur, investor, and philanthropist Jerome D. Love. We are committed to teaching you how to build wealth so that you can build your community. At the Black Money Tree, our goal is to empower wealth creation and create economic self-sufficiency in order to empower generations to come. Society grows great when old men plant trees whose shade they know they shall never enjoy. Season 1 is powered by Wells Fargo Bank. Welcome to the Black Money Tree Podcast.
Hi, my name is Jerome D. Love, and I'm the host of the Black Money Tree Podcast. I'm super excited about the Black Money Tree Wealth Development Strategy because our goal is to help you to build wealth so that you can then build your community. When you look at research suggests that most net worth for most people in America, specifically African Americans, tends to be in their home. So home ownership is critically important. And today we're going to have a discussion of how to get money to access a home. And we have with us one of the nation's premier real estate minds, mortgage brokers, Mr. Danny McKinney. He has several companies. I can't remember them all, so I'm going to let him kind of give us the introduction. So, Danny, welcome to the Black Money Tree Podcast.
I appreciate it, Jerome. Thanks for having me.
So, now you have several businesses. Most of them revolve around real estate. So, I know one is DMAC Capital. Another one's Diversified Loans. Tell us a little bit about your companies and what it is that you do.
Okay, so first company being Diversified Home Mortgage is probably the mother company. It's a residential real estate mortgage company where we do residential loans. So we do VA, FHA, conventional, USDA, non-conforming, bank statement programs, investor loans for residential property. So Diversified Home Mortgage runs that part. Sister company, which is DMAC Capital Funding, who does more of the commercial side. We do funding for apartment complexes, for buildings, for retail locations. And we provide funding, and we also do investments and development with DMAC Capital Funding. And then we also have McKinney Real Estate Inc., which is my real estate brokerage, because I am a real estate broker for 30 years now. And so we broker, and we also fund loans, and we also broker mortgages.
Now, you took a unique path to your current business. We were just talking during the break. You actually have a JD from Texas Southern University.
Correct.
You have a bachelor's degree, and you do pretty much nothing with that. So let's talk about that.
Well, my bachelor's degree is from Houston Tillotson University, which is HBCU, out of Austin, Texas, and I got that in finance, business administration with a concentration in finance. Then I also went and got my law degree from TSU, Thurgood Marshall School of Law. I finished there in 1996. But I had my real estate license before I went to law school. And while I was in law school, I got my broker's license. And after law school, while working for a law firm, I said, you know what, real estate was my passion. And so I fell back into real estate. Right after I graduated from law school, I opened my real estate brokerage firm. And then 2 months later, I opened a mortgage company right after that, because I felt like if I controlled the money, control the financing for my clients, then I'll be able to get them in control and make sure that they get into their homes. And so that's how that started.
So let's back that back. You if you could go back, college is expensive. We
Yes.
talked about that too.
Yes.
Would you make the investment that you made in college knowing that you're going the path that you're going down? Or do you think it was critical, specifically to JD, to get you to where you are now? Do you use that at all, and would you do it again?
I would not do it again.
Okay.
Because I determined what my passion was. And law was something that I wanted to add to my passion, because real estate was always my passion out of undergrad. But I wanted to add law to it and practice law and also do real estate. But I wouldn't do it again. As far as college is concerned, I think, most people should invest in either some type of skill set. The education, the college education is great, I believe, for relationships, establishing an educational foundation, but there are life skills that you can learn out here without a college education. And me being a real estate broker, also a mortgage broker, those licenses that I have do not require any type of college education. So looking back, I would suggest any young person You may want to add maybe something where you can be licensed without having the college education, and add to the college education if that's what you want to do. If not, focus on getting that license or that skill set that will pay the bills.
You know, it's interesting that you mentioned that. I don't have any statistics, but let me just say this. In my family, there were 4 kids. 3 of us got college degrees. 1 didn't. Mm-hmm. The one that didn't makes more money than all of us. Right. And he's an entrepreneur. He has a janitorial company in San Antonio. He has a mobile pet grooming company called Happy Scrappy. So he has a fleet of mobile pet grooming trucks that go around the city of San Antonio. He's looking to expand into Houston and Austin. But one of the things that I've noticed, once again, I ain't done no research. People that don't tend to go to college like that have been told all their life you need college. And they kind of have this chip on their shoulder. It's like the person that doesn't get drafted number 1. Right. They got the chip on their shoulder. They want to prove their value. Right. And one of the things that I've experienced as an entrepreneur, having to hire people, when you hire people that have that college degree, they kind of have this chip on their shoulder like, you supposed to pay me X amount of dollars. Right. I have never had a regular job. I don't get paid unless I sell your house, unless I close the deal. So that's typically the way I approach hiring employees. If you are supposed to accomplish a task, don't expect to get paid if you haven't done it. And so for me, it kind of seems like I advocate for college too. I tell my kids to go to college, right, but I tell them to get a skill set too. But I see a lot, it's almost like it's holding people back. They have an entitlement spirit, like, you're supposed to give me money because I have a college degree. Right. Talk a little bit about that. Do you see that as well?
Well, I'm of the opinion that, why waste 4 years when you could educate yourself? There's a lot. I mean, with Google, University of Google, you can learn all types of skill sets. Nowadays, you can get real estate licenses online. You can get other licenses online. You can learn coding. You can do all these other things. So, as far as I'm concerned now, although my daughter's in college and she just finished high school, but her first week out of high school, she finished her mortgage classes because I wanted to instill in her, if you get those licenses, you don't necessarily have to work for anybody. Those licenses allows you to basically work for yourself, and nobody can fire you when you're in a position where you can work for yourself. So, but she wants the college degree as well, and so I support her on that end of it. But she's also working with me, so I'm educating her on life skills in terms of being able to run business and how business is done, credit, real estate, and buying real estate. So, but no, I'm just against college degrees right now, and I'm just on that right now. Yeah.
So let's shift. I don't want to get too controversial here. Right. So with the Black Money Tree, we're about building wealth, and a big part of building wealth is real estate. Mm-hmm. And in order to buy real estate, for most people, you need capital. And that is a big challenge. I can tell you my personal story, and I know a lot of the stuff me and you have chopped it up on it, but I want people to kind of get an in on our conversation here. So I remember when I kind of built my portfolio, I did it. I was old school. My daddy taught me not to have no debt. He said, boy, the key to having money is spend less than you make and don't charge nothing on the credit card. So I was just averse to those type of things. All right. So my portfolio is pretty much on self-funded. And I remember when I started looking at trying to grow and scale, I say, I'm going to need some money. So I'm going to go to a bank. No problem. I have all these houses. I own them cash. A bank's just going to give me money. At minimum 50%, but probably can get 70, 80%. And I was having the hardest time of getting money. And when I talked to my line brother who works on Wall Street and deals with finance, and I was telling him, man, I own all these houses cash. I'm making a 33% return. It makes no sense. And he said, Jerome, think about this. If you make a 33% return, how much more money does the bank get? And I was like, well, nothing. They just get that. He said, so what do you think they're concerned about? Right. So take me in the mind of a banker, a mortgage broker. When I come to you and I say, hey, I need some capital. I'm trying to buy some land. I want to develop an apartment complex. Tell me, what are you looking at? And what are most people doing wrong?
Well, first and foremost, you want to look at what asset class are you buying in. So if you're buying a apartment complex, small apartment complex, the number one thing we want to look at from that perspective, from underwriting standpoint, is how is that apartment complex cash flowing? Because that's what, as a bank, we want to look at, is this thing going to be able to pay us back? We're not too concerned about you because we're investing in that asset. So if that asset is cash flowing, then that's the number one thing. The second most important thing is your reserves, because if something hit the fan, we want to know that you can weather the storm and you have additional reserves to cover you in the event, because things do happen. You know, when you run an apartment complex or managing an apartment complex, you definitely have issues in terms of, you know, maintenance. You got to pay realtors for fees to bring you tenants, you know, replacing carpet and all these things. So these things are cash intensive that you need to make sure that you have those reserves. So that's the second thing. And thirdly, you know, we look at credit. That's one thing. But I've done loans for individuals who have 620 credit scores and they buy apartment complexes. If you're buying commercial real estate, you're going to be looking at anywhere between 25 to 30% that you're going to need to put down. Now, there are some other programs when you go into private money or what we call hard money or whatever, where you may be able to get in a little bit cheaper because of the way it's structured, but you're going to pay a higher price and interest for those particular loans. I use hard money all the time. I get in, but I get out with bank money once I get in and stabilize the property, or I make sure the property is in a position where it can be done through a bank. So hard money is a great avenue to get in. Sometimes allows you to get in cheaper, but you're going to pay higher interest rate on that. So the goal is not to stay in there no more than 12 months, you know, preferably 6 months.
So talk a little bit about hard money for those that don't really know what it is. It's basically a loan that you can get that has a higher interest rate, but it's easier to attain. What typically, is that right? First off, is that correct?
That's
right.
And
then tell us what are typically the qualifications to get a hard money loan?
So on a hard money loan, basically there's several different, well, I would say two main ways. You can go to either an institution or a company that they've pooled money together and they loan this money out on hard money. Or you can go to an individual, which I've done many a times to, I've had individuals fund millions of dollars in real estate for me, and maybe $250,000, $300,000, $500,000 at a time. But what happens is, you know, those individuals can turn their money into a 20-25% return on their money on a yearly return. Same thing with the hard money. Typically, you're going to be looking at interest rates around 10, 11. You may go down to 8% depending on the project or the individuals involved, but you're going to pay that higher interest rate. And then they kind of loosen the requirements in terms of you coming in. Reserves is important, so you're still going to need some capital and show that you have that capital, whether it's your own capital or whether or not you pooled money or syndicated money with other individuals to buy that particular property. I've done deals where I didn't have the cash, so I brought on somebody who partnered with me who had the cash. They had to sign on as a guarantor on the deal, but 2 or 3 months later, I was able to refinance it in my own name through a bank and got them off the deal, so their risk was gone. But however, they got a nice return on their money for the use of their credit, as a matter of fact, because they actually didn't use any capital because we just had to show their bank statement showing that they have the reserves, but they came in as part. So there's several ways that you can structure deals on the hard money side that maybe banks are not going to allow you to do.
So let's back a minute. You said something very interesting. I think I know the answer, but I want to make sure the people out there are getting it. You said if you asset class, you started out, you said apartment complex, they don't care about you.
Right.
The biggest problem that I tend to get, because I have single family houses, which I believe is a different asset class,
right,
all they want to know about is me,
right,
you know?
Right.
So I'm saying, look at the asset, don't look at me, look at what they're producing, look at the equity, and they're more concerned about me. Talk a little bit about that.
Well, it just depends on the bank.
Okay.
You know, I've gone to some banks and they ask questions that I'm like, 10 other banks are not asking those questions.
Yeah.
So sometimes it really just depends on who the bank is and the underwriting and what their criteria is. Majority of the industry doesn't necessarily, if you're talking about an apartment complex or a income producing property. They want to know, is that income producing property producing? And then they want to know, okay, what are your reserves? You don't have to have 700, 800 credit scores. If you got 620, 650 credit scores, that's okay. But they want to look at, do you have some reserves, or does your team have reserves? And that's mainly what they're looking at. And then, of course, if you're going to go in and rehab a property, they want to know, have you done that before? If you haven't, that's fine. Bring someone on who has. If your contractor's done that and he has a portfolio of showing, hey, yeah, I've done that. Hey, bank, this is my contractor. This is my general contractor. He's going to be the one who's going to be doing the work. So they'll look at that and say, oh, okay, we're okay with that.
Now, see, what I think I'm hearing from you, and just what I've learned from my experience, that there's typically a bank that will finance any deal. It's just about shopping around and finding the right bank that has the right need, the right fit. Because I know I recently lost the deal. I called you about it. I didn't tell you I lost it, but it was about 7-8 acres of land. I was going to build, 20, 30 houses. We didn't have it plotted out and everything. So the owners of the land refused to give me a contract until I had the approval letter from the bank. The bank refused to give me the approval letter until I had the land under contract. So I'm kind of like, well, how does this work? I can get the deal done. I built houses. You can see my portfolio. You have everything. And unfortunately, I haven't really looked lately. Land might still be available, but I just kind of hit a stalemate because it's kind of this whole chicken or the egg thing.
Right.
So I would say, what's your advice on that? But I think it would be just find another bank or probably try to find some other alternative forms of funding, hard money, private equity. Talk a little bit about that.
Yeah, I mean, over the last 20 some odd years, I've focused on being able to have those assets, what I call assets, access to capital, access to banks, whether it's hard money or banking money or individuals that will say, hey, Danny, yeah, I've made money with you before. Here, here's $200,000 to buy that property. So yeah, sometimes you just have to, find a different pool to put your fishing line in, your fishing pole in, and see if they're going to bite on your deal. And then, or either work with a broker like myself who knows, okay, no, that deal's going to fit over here. Because I've done that, I've been there, seen that happen before. I'm going to put you over here because I know they'll buy the deal based on the criteria that you have on your particular deal. Yeah, I mean, but a lot of times when it's not a perfect bankable deal and it's more riskier, you may have to look at other, non-conventional type funding. So, and that's what I've come across a lot of old school investors, and they're like, man, I'm not paying that interest rate, and well, I mean, some cases, if you're going to have a lot of equity on the other side, once you get the deal done, okay, you're going to pay a little higher interest rate, which may eat up some of your equity on the front side, but at the end of the day, you get the deal done, as opposed to say, well, no, I want to either go to a bank, and if the bank won't do it, I don't want to do it. That just doesn't make any sense when you're doing real estate investing. Yeah. So talk about some of the projects that you're doing. You're doing some pretty big things here in the Houston area. I believe, I'll let you talk about it. Tell a little bit about some of the projects you're working on. I don't want to put too much of your business out there. I'll let you tell what you want. Right. So we're working on we're developing some townhomes in Rice Military. We're building those from scratch, and one is pre-sold at $1.4 million. It's a 4-story rooftop deck, contemporary style home. We're also working on a 147 home development of 33 acres in South Houston. So we're raising capital on that. So we're bringing in, syndicating or bringing in with a fund, bringing in individuals to invest in that project, like $6 million to develop that project. That neighborhood is going to be in the price range of $300,000 to $400,000 homes, anywhere between 15 to 2,400 square foot homes. But it's going to be a nice development for individuals who want to be in that area and also have access to downtown, the medical center, and what have you, and be in a nice neighborhood. It's called Paradise Place.
Okay.
We're also doing the preliminary plans and infrastructure for a 210-unit apartment complex. We're also funding and a project manager on a 78-unit apartment complex in Westheimer and West Hollow. And we have a 18-unit townhome development in north of 610. I can't remember the neighborhood. So we got quite a few projects, and we have other projects that we haven't just really teed up right now. We have a lot of individuals who are coming to us for financing. We just financed a hotel here in Houston. So we're doing a lot of projects.
So I asked that question because I want people to know the types of deals that you're doing and that you know what you're talking about.
Right.
But I know when you start talking about 140 lots and this, that, and the other, people say, oh, man, this guy's over my head. So let's talk a little bit. Let's break it down a little bit more foundational to your average person. Buying a home, your first home. You have a mortgage company where you just do traditional loans as well. Mm-hmm. As a real estate broker, one of the things I always tell people, it's interesting. When I find people and they say they want to buy a home, typically I'll say, well, have you gotten qualified? Normally the ones that will tell me, oh, man, I ain't got it, but I'm good, man, I'm good, everything perfect, those are the ones you got to work with. But then there are other ones that'll be like, nah, my credit's probably not that good, I don't have enough money. They tend to be good. So talk a little bit about the home buying process.
Okay. What
are the things you're seeing? And what are you looking for on that end? If a person's trying to buy a home, what are some of the first steps they need to take?
Well, if you're trying to buy a home, the first step is to apply. Make sure that you apply for a mortgage. With my company, basically, you can go online. It takes you 10 or 15 minutes to apply. And what we do is we pull your credit and then we evaluate your whole entire situation. What I try to do is I try to put people in the boxes. First thing we look at is what your credit score is. Well, if your credit score is below 620, you can't go conventional, okay? That's just conventional guidelines. So that automatically puts you in a box of maybe FHA or maybe a non-QM type loan. What that means, non-QM means non-qualified mortgage. And those pretty much are the two options that you can fall into. But if you have 620 or above, you can go conventional, you can go other programs. VA, you can do down to 500 credit scores with a VA loan, and up to $2 million on a mortgage for a VA. So there's different programs that we have and we provide for people to. But the first step is to apply. Most people will shoot themselves in the foot thinking that I got these dings on my credit, and a lot of times they're 20 points, 30 points away from 580 or 620 to get their loan done. And a lot of times we go in and we look at it and we'll do what we call a simulator and look at it. Okay, well, look, if you pay this balance down on this $500 credit card, which you have at $499, pay it down to $50, that's going to boost your credit scores 20, 30 points. That's going to take you over where you need to be. Boom, we got you in the home now. We go help you find a home now.
Yeah.
So it's those little tweaks that you should do, that you should also speak with a mortgage company to say, hey, this is my situation, as opposed to being afraid. Say, well, I know I got some dings on my credit, I'm not going to apply. Let the professionals look at it and evaluate your situation and say, okay, well, let's look at it.
So now the interesting thing, and me and you have had this discussion, you have a mortgage company, you build houses, you develop homes, so you obviously are for real estate. But
right.
You're renting your house.
Correct.
So let's talk about that decision.
Yes.
You shocked me. You floored me when you told me that.
Yes.
My mind was just blown because you're not a millennial. I won't
Right.
say your age, but go
Right.
ahead and talk a little bit about that.
Well, I mean, to be honest with you, as you know, I just recently got engaged and what have you, and me and my fiance, we moved in together. So I moved from a high rise.
Okay.
So as a single person prior, high-rise living was excellent for me.
Yeah.
Okay. So I had no interest in saying, let me own this high-rise or, buying another home. So I would have rented, and because the home that I live in doesn't pay me, okay, I can use it to a certain extent. I can write off some parts of it because I'm utilizing as part of my business. I have an office, home office, so I could do that and write off some of that on my taxes, and that's mainly the benefit that gives me. But it also gives me the ability to say, well, if I don't want to own this right now because it's not paying me, I'd rather own assets that are paying me some type of income or going to give me some type of cash flow, so to say, as opposed to paying for a home at this point in time in my life. Now, that doesn't mean I won't buy the home that I'm living in, because I do have that option, because I did put that in my lease. But however, At this point in time, it's not in my benefit. It's not to my benefit to own. I'd rather invest that money into assets that's going to pay me on a monthly basis or on a yearly basis or what have you.
Well, let me ask you, my perspective or my retort would be to that, if you're spending money, why not spend money that's been building equity? Because you got to pay your rent.
Right.
And many times the mortgage is lower than your rent, but you're building equity. What would be your response to that?
Well, I look at it from a commercial standpoint. If you want to build equity, a lot of times you build equity by going in and putting more money down, and then you can do an interest-only loan if you're planning on keeping it for a shorter period of time, maybe 10 years or whatever. So with that same concept, I look at real estate for a personal standpoint. If I'm going to invest in it, I want to have some type of benefit. Either it's going to give me a tax benefit, or here in Houston, the equity bill is about 3% a year. So it's going to take me 10 years to get the 30% equity. And then within 10 years, of course, the market crashes and what have you, the equity values go down, then they come back up, whatever. At some point in time, I don't necessarily need to pay that. And then you're going to talking about putting, on $1 million home, it's jumbo. So you're going to have to put a large amount of money down on the property initially. So why not put that into something that's going to pay you every month? Yeah. So, those are some of the things that it's not for everybody. Yeah. It's not for everybody. And it's not to say that I would not buy another home, but at this point in time in my life, I'm using the benefit of, what can I write off on this particular property? How can I utilize this and give me a tax benefit? In some cases, taxes are 15 to 20, 30%. So if you can write off your home, right off where you live, because you utilizing it to run your business, or effectively you're putting in your business through there, then you can utilize it and benefit from that standpoint. So there's different ways you can kind of structure yourself.
So I'm going to leave it at that. Well, thank you so much, Danny. This has been a pleasure having you. Is there anything else you'd like to share with the people, social media handles, where we can follow you? Where do they go if they want a mortgage loan?
Well, first you can go to DannyMcKinney.com. That's my main website for me personally. Then, of course, you have DHMLending.com. I'm going to be having a podcast myself, which is going to be the Real Estate Wealth Builders. I have this shirt on, which a lot of people are saying, man, it's going to be controversial. Like, if you're not building wealth, you're not black. I'm like, well, 97% of the people voted for Biden, of us black people voted for Biden. And he said the same thing. If you're not voting for me, you're not black. So if we're not building wealth, you're not black.
Yeah, I like
so right now, I want, and it's really a call to action. Because I want us to make sure in our community that we're building wealth. Yeah. And I have the vehicles to help people do that.
So let me ask you one other thing. You mentioned that you talked about a lot of your partners and equity and this, that, and the other. Are most of them black?
I would say 70% of them are black.
70% are black.
Yeah, okay. 70% are black. And most of the loans I do are, I would say 90% are black. So, that's my community. And that's who generates and who pays my bills. So basically, that's where I go to, and that's where I promote to.
So there you have it. If you want to start building your wealth, one of the best ways to do it is to own you some real estate. Now, personally, I believe you need to own the real estate you own in. We heard Mr. McKinney's perspective. But even if you don't own the home you live in, you need to own some real estate that puts money in your pocket. That's the beauty that I love about real estate. It's an asset. It grows in appreciation, and it can put money in your pocket. So make sure for more tips and tools about growing your wealth, go to theblackmoneytree.com, follow us on Instagram, Facebook, and get a copy of the new book, Closing the Wealth Gap. Thank you so much for tuning in. Thank you so much for tuning in to the Black Money Tree podcast. Don't forget to like and share this video. And if you want more content like this, follow us on Instagram, Facebook, and Twitter. We'll see you next time.